Welcome to the PlanStrongerTV market update for Wednesday, April 1st. No fooling. Let's dive right into your numbers. There's your Dow, your stock, total stock market index, S&P 500, all of those for 2025 total returns. Now let's slide those over and take a look at where we are year to date. And, Robert and I were just talking before we got started that, when you look at things over a little longer period, it can help eliminate and strip out some of the noise and the anxiousness of the day. So look at those year-to-date numbers. Dow off 3, total stock market index for the Dow 4, S&P off a little more at 4.3. NASDAQ, of course, more volatile, down almost 7. But look at that, small caps, almost 1% up. So I continue. If we just watch the market, they'll make the case for diversification. Foreign stocks off slightly, again, not nearly as much. And there'll be opportunity there going forward. We'll talk about that. And then bonds pretty much flat. So Robert, we got a lot to talk about here, and we have a short time to get there. We're going to dive right in. So, the first quarter of 2026 being dominated, of course, by the war with Iran and all of the related economic impacts. So thoughts about that, and then any surprises or things that are going on despite the war, despite the dominant media coverage, despite all the things that are linked to economic activity that is tied to the war and oil and all those things that are kind of getting overlooked.
Yeah, first and foremost, I love not only, David mentioned here's the year-to-date numbers, but it's also the full quarter. We're in April 1st, we're done with one full quarter. So the numbers you saw are for the first quarter, 2026. And, David, a couple of things kind of, when I look back at the first quarter, a couple things stood out to me. One is employment and the labor market. It seems like the media is always, the labor market, just like inflation is going to spike any day now because of trade, and we're moving on 1 year since the Liberation Day tariffs, we're always worried about the labor market, but the resiliency in the labor market is interesting, especially when you look at the dynamics in terms of immigration. With the closing of the border, instead of having hundreds of thousands of people coming across and needing to find jobs, the job creation numbers are much lower than they were, but we don't need the higher number of job openings. So for example, JOLTS came out and it slipped from 7.24 million job openings to 6.88. And people would say, oh my goodness, employers are looking for fewer people, cracks in the labor market. But those numbers are very much in line with pre-COVID, and nobody was screaming in 2018 or 19 about labor market weakness. So we're healthy there, and also hires are dropping, but so is the quit rate. In fact, both of them are equivalent to or the lowest since 2020. So what we're kind of seeing in the labor market is kind of a situation of full employment rather than weakness there. Real quickly, the number 2 kind of surprise is consumer confidence. The latest number came out for March. The last 2 months, February and March, one being with the Iran war, consumer confidence has actually gone up the last 2 months. The number just came out yesterday, expecting a reading of 88. We got 91.8, which was higher than the previous month. So just a little about that, it's broken up into 5 components. A lot of people, the present situation index is actually up. And what went down a little is the expectation index. A little further out, people are a little worried, is the Iran war going to be, that's kind of natural, but it's telling that, consumers are still spending, and that 3 out of 5 of those metrics of the of consumer confidence actually went up. So, I think we try to, when there's a lot of negativity out there, we try to pull in, hey, there's a lot of good stuff out there. And then when, the markets are euphoric, okay, well, here are the risks. So we kind of do a little contrarian just to kind of to give people perspective in terms of against what the media and the financial press is harping on.
When all else fails, look at the data. Always look at the underlying economic data. And that kind of brings me to my next question for you, Robert, and that is, with all of what you just shared related to the economy, the statistics that you shared, employment, all of that, how has that impacted, in your mind, how investors are looking forward in terms of their investment portfolios. Is there a sense of optimism? Is there a bullishness? Is there still, the question investors always want to know, is there more room for the bull market to run? We're in a correction, right? We've had a full-on correction. First, it was a pullback of 5. Now we've crossed the 10% threshold of a drop from a prior high, even though the year-to-date numbers we showed you are not a full 10%. So we're seeing some recovery off of those lows. Is that indicative of a more bullish investor?
I would say yes, and two factors. Number one, there's a lot of money on the sidelines, a lot of money in money markets, CDs, and in cash. And as the market starts to recover, we had a strong day yesterday. Not saying the market will be up today, but the futures are looking positive. They're in the green right now. So there's, when the market starts coming, a lot of hesitant investors will start buying the stocks and pushing prices up even more. So that's number one. Number two, we've seen investors really, with the uncertainty, with the election year, with the war in Iran, we've seen investors really move. Not a lot, they haven't completely gone out of growth. That would be a mistake. The tech stocks, the NASDAQ, which is heavily weighted in tech. But we've seen them go into international, gone into emerging markets, the small caps and mid caps, the bonds, down half of 0.1%. So you look at the numbers. Aside from small caps, being invested in a little bit of fixed income has really kind of dampened the volatility that people have would otherwise have witnessed in their portfolios had they not been invested 20-40% into bonds.
Okay. Any specific areas in the investment universe that maybe folks should be thinking about looking at, or that there's some excitement around?
International, I believe, is not done,
Okay.
outperforming. And then, of course, small and mid caps. Mid caps especially have been, we focus on small caps. We don't have an index showing mid caps on here, but, small caps but mid caps have been beaten down a lot worse than even large caps. So that's a potential sector that can show a lot of promise as well.
Okay, so people should take half of their money and put it in international, half into mid cap, and just sit back and wait?
Yeah, I didn't say that.
That's jest. I know you know that watching our reports. And the point, of course, I'm making is that we need to be very measured. So the commentary and discussion with Robert is that we're looking at areas of opportunity. We're not suggesting anybody overweight or underweight for that matter. We're just, this is some context in which we make investment decisions. So, and as I said before, we've got to look at the data. We've got to check ourselves. We need to look at where we are, not just, we had a correction. This is really bad. And then what do you know? The market comes back up, jumps up. What was it? Dow was up almost 3% on March 31st. We had a very quick recovery. So, the old saying, you miss a day, you miss a lot, and that can happen. Yes. Final thoughts.
Final thoughts, remain diversified and stay invested. It's okay to always look at your portfolio, look at your investment mix, make some changes on the margins. And again, that's the key word, on the margins. But again, like David said, we make a recommendation or say, hey, this looks promising. Yeah, maybe overweight that a little bit, but definitely stay diversified and stay invested.
Yeah, so when we say on the margins and overweighting, we may need to make some tweaks or maybe some adjustments to fine tune your portfolio. But unless you are close to needing this money for a specific purpose that you have invested, the news of the day should not dictate how you invest. It's your personal situation. It's how long before you need the money that drives how much risk you should be taking. There you go. All right, so that's the wrap. We'll be back soon to give you more information, help you plan stronger.